Try to stop a freight train on the tracks, and the result is predictable. Yet in financial markets, retail traders attempt the equivalent every day. This is the Relative Strength Index, or RSI. It tracks price velocity from 0 to 100, using 30 and 70 as key thresholds. Conventional wisdom suggests when RSI breaches 70, the asset is overbought. Traders conclude the price is overextended and a reversal is imminent. This approach treats the market as a mean-reverting closed system, like a pendulum that must eventually swing back once it hits a certain height. However, markets frequently transition into runaway trends where mean reversion fails. Relying on the 70 level as an absolute ceiling drives heavy losses for retail accounts. Using a velocity oscillator to predict price ceilings ignores the mechanics of momentum, turning a useful indicator into a dangerous trap. We observe this in the historical data for BHEL. The RSI crosses above 70 while trading at 80 rupees. But instead of dropping, the price decouples, skyrocketing past 90 and 100 rupees, even as the RSI remains pinned in the overbought zone. For a short seller, this 20 rupee move against a standard lot size of 10,000 shares results in an immediate loss of 200,000 rupees. When the RSI holds above 70, it signals a phase transition. The market shifts from a contained state to an expansive one, where resistance dissolves. Below 70, the market functions like a local road with constant speed bumps. Above 70, it enters a high-speed highway where those friction points are no longer present. In this context, an RSI reading above 70 serves as a measurable indicator that trend acceleration is currently at its peak. Even with high momentum, daily breakouts can fail due to localized volatility. To trade these moves effectively, we have to distinguish between high-velocity signals and random market noise. We solve this by applying the principle of structural dominance, where the momentum of lower time frames is filtered through the higher time frames. Looking at Coal India, the monthly RSI crossed 70 in July 2023, establishing a long-term structural bias. By August, the weekly RSI followed suit, aligning the intermediate trend with the macro momentum. When the daily RSI cleared 70 in September, all three timeframes were in sync. This alignment provided the structural backing for the explosive price move that followed. Supported by all three layers, the stock surged from 230 to 280 rupees without significant reversal. High-velocity moves on the daily chart are significantly more sustainable when they are backed by the massive momentum of the monthly time frame. When the monthly RSI is sustained above 70, the technical bias shifts heavily toward buying. In this regime, short selling carries a high statistical risk because the macro trend is actively expanding. During these strong uptrends, we watch for daily price corrections where the RSI pulls back toward the 50 center line. In a bull regime, the 50 RSI line acts as hidden support, where price frequently stabilizes before resuming its primary trend. Rather than a sign of exhaustion, these pullbacks represent a return to the mean on a lower time frame, offering a point to enter the existing macro trend at a better price. These market dips function as strategic reload zones, where price momentum pauses briefly to gather energy before the next explosive leg of the expansion. Multi-Timeframe RSI alignment identifies trends, but high-probability execution requires layering additional technical filters to manage risk. we introduce structural geometry using Fibonacci retracement. Specifically, we look for price to test deep levels like the 78.6% line. Testing a deep Fibonacci level provides a clear area of structural interest. At this specific level, we look for price action validation, such as a bullish piercing candlestick pattern. This candlestick formation indicates that buyers have successfully defended the structural level, suggesting a shift in localized sentiment. Optimal entry points emerge only when macro momentum, structural geometry, and localized price action all lock together to signal the exact same conclusion. The CDSL chart exemplifies sustained momentum. The monthly RSI remains pinned above 70 for 18 consecutive months, while the stock climbs relentlessly from 300 to 1700 rupees. Traders using standard overbought rules receive premature sell signals at 500 and 800, exiting far too early. By trading an oscillator reading as a hard ceiling, a trader misses the majority of a 500% move. Capturing these significant trends requires trusting the structural momentum indicated by the higher timeframes over short-term overbought signals. Significant returns are often generated by participating in these extended phase shifts rather than betting on their immediate failure. Technical indicators provide data on market conditions, but the common error is interpreting that data as a set of fixed, unshakable rules. An oscillator like the RSI is a speedometer. It measures how fast the market is moving, not how much room is left on the road. Using a multi-timeframe matrix helps filter the noise of individual charts, allowing traders to align with the underlying structural trend of the market. Moving away from the fear of an overbought market and toward a data-driven framework allows traders to move in sync with momentum instead of fighting it.